This is one of the strongest advances that we have seen in the developed international stock category in decades.
Hey everyone, thanks for tuning in to our February 2026 Investment Committee Update. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we're using our rules-based investment discipline to inform the current positioning within our investment strategies. And before we get into this month's investment review, we want to share some exciting news on Reveille's continued geographic expansion. We are thrilled to announce the opening of our fourth office in Evans, Georgia, which is adjacent to Augusta. Based out of this new office are our new advisor partners, Will Kaywood and Nick Smale. Welcome to the Reveille family, Will and Nick. So let's do a little preview. Market rotation continued in February as former leadership groups, namely the large cap U.S. technology sector, lost ground, down about 2.5%, while the average stock in the S&P gained nearly 3.5% for the month. Continued strength was evident in dividend-paying stocks, high-quality and value-oriented stocks, small cap stocks, and also international stocks. Despite this broad strength, the S&P 500 declined about 0.5% for the month due to its heavy concentration in growth stocks. Now, concerns around the AI bubble worsened during the month as further signs of trouble within private lending have emerged. Interest rates fell slightly for the month, which is a welcome sign for borrowers, and the U.S. unemployment rate stands at around 4.3% versus 4% about a year ago. The U.S. Supreme Court ruled against the Trump administration's authority to impose tariffs under the IEEPA, which of course causes a further pivot in the prevailing tariff policy from our country. Now with that, I'm going to turn it over to Stephen to take us through this month's review.
All right, thank you, Chad. Let's dive in. And I want to begin today with a word of caution, and it's the same word of caution that we shared with you last month, and that is that the S&P 500 has never been less diversified than it is in the present day. 10 of the largest components in the index comprise 40% of the entire market capitalization of the entire index. That's nearly twice the size or more compared to historical standards. And 8 of these 10 largest components today are technology type companies that fall under the growth classification. And while over the long term, stocks are likely to experience similar average returns regardless of whether they are growth stocks or value stocks, historical cycles certainly exist where one classification or style of stocks is going to outperform the other, and oftentimes it's in large amounts. Growth stocks, as an example, have experienced perhaps one of their longest periods of outperformance versus their value counterparts in history. We've seen since before the financial crisis, when that relationship between growth and value stocks bottomed, it has been a significant advance of growth stocks relative to value. There have certainly been some interruptions along the way, but we now find ourselves at a level where we would expect this ratio to encounter some resistance, and that's exactly what has been happening since late 2025. And this is the real concern. If the largest components of the U.S. stock market are comprised almost entirely by these growth stocks, and these components are making up more of the index than they ever have, and they're starting to underperform, what impact might that have on the U.S. stock market? What do we need to prepare ourselves for? Well, we don't want to make any predictions, but in the prior instances where we saw large reversals from extremes in this ratio, those were not environments that we would classify as bull markets. So that could have been when this ratio was pulling down during the dot-com bubble as it was bursting. When this ratio was troughing back prior to the financial crisis, this is when value stocks were as expensive as they had been relative to growth in many, many years. And So the energy sector, the financial sector, as this ratio started moving the other way, this was not a positive environment for stocks, nor was the environment that we saw in 2022. So the real concern that we should have at this point in time is, if we continue to see a pullback in this ratio, is that going to coincide with another bear market? We're going to have to stay tuned and find out. Now, the other issue that we tend to see when asset classes are starting to struggle is that they're often underperforming many of their alternatives. And that's exactly what we're seeing here, where the S&P 500 is starting to underperform developed international stocks, emerging markets, small caps, commodities, even bonds. And so the S&P was the leader for a very long time, But it's now starting to underperform a number of its alternatives on a relative basis, and that typically is indicative of something that is going to struggle on an absolute basis as well. Now, I feel like the writing has been on the wall for this type of market environment that we've seen so far in 2026. It's been on the wall for some time. And in some ways, we feel like we've been crying wolf, talking about this concentration in the market and what happens on the other side of it. And all of a sudden, that switch has flipped here in 2026. Now, over the last 3 years, we have experienced one of the narrowest markets that we have seen. And what I mean by that is the number of stocks within the S&P 500 index that were actually outpacing the index had gotten to be very low by historical standards. Less than a third of them were outperforming. And that's a characteristic more of market bubbles, one that we last saw in the late 90s. Now, those market environments, they can be very strong if you're willing to hold a concentrated portfolio, but that often ends in tears for the people who are doing so. So, traditionally, the period that follows these episodes of narrow market advances typically sees an explosion in the number of stocks that are actually outperforming, where there is going to be broad outperformance versus the index for most stocks. Now, that doesn't necessarily mean that it's happening in a great market environment, because when that happened in 2000, 2001, 2002, that certainly was not a bull market. So perhaps there is a bear market that's coming, maybe even a recession for the economy. That's what happened last time. We're going to have to find out what happens this time. But so far in 2026, we've got nearly 65% of the stocks in the S&P 500 that are outperforming the index. The average stock within the index is up nearly 7% year to date. But because the biggest stocks in the market are now struggling, the headline S&P index, it's barely even positive for the year. And that concentration risk that was an asset or a tailwind for the market for a number of years that really masked a lot of weakness beneath the surface, it is finally coming home to roost, and it is now a headwind for the S&P 500. Now, we've talked a lot about this in some of our prior reviews. We've posted a lot about it on our YouTube channel. If you're not subscribed to our YouTube channel, please go there, Reveille Wealth Management, subscribe so you get the latest of our thoughts when we are posting updates about what's happening in the market and in the economy. But we have been concerned about the prospect of an AI bubble, and we still maintain those concerns today. A lot of the companies that are in this space, they are burning through a tremendous amount of money on their pathway to profitability. So OpenAI, which is the parent company of ChatGPT, recently released that they do not expect to be profitable until the year 2030. But along the way, they expect that they are going to burn $218 billion before they get there. That is many orders of magnitude larger than what we saw for companies like Netflix and Uber, even Tesla. And the question is the market going to continue to extend credit? Are investors going to continue to put their money into this hole for another 4 years just so this company can get to a place where they're going to be profitable? The jury is still out on that. Now, the other issue that we are finding in the market right now is that a lot of the projects that are being built right now, these data centers, that we are now, there's real concern about perhaps that we are overbuilding. We're creating capacity that we don't need. And much of the funding that has been going into this space, it is not coming from traditional banks. It's coming from what we call non-bank lending. It's investors that have had their capital pooled together, and the companies that are aggregating that money, they are then lending it out to these various projects. And these projects are pitched to investors as a securitized investment that's backed by real estate, and they're going to get a certain amount of yield on that position over time, and it's going to be non-correlated with the rest of the market. Well, the issue is going to be that if a lot of these data centers and if this build out, if these things never actually get put into operation, then these folks that have lent money into this space, they're going to be left holding the bag. And what we're finding out right now in a lot of these private credit pools is that the underwriting standards that have gone in to lending this money out have been very lax. And it's all too reminiscent of what we saw with the mortgage market before the financial crisis. So this is a real cause for concern, and we've documented this on our YouTube channel, so please tune into those if you have not gotten those videos. So the first side of this problem, this duality of the AI build-out, is that perhaps we are overbuilding, and there are a number of projects that are underway that are not going to be brought to completion, and the people funding those projects are going to be left holding the bag. That's a real problem for those investors. The other side of the equation is that AI has already made extraordinary advances, and that technology is able to replace a lot of jobs. It's replacing high-paying skilled jobs, and entire industries like the software industry is now a going concern, as if the business model of software as a service, or SaaS, is really being called into question. And so I actually asked Gemini to give me a list of the stocks in the U.S. software industry to show me the percentage declines that they have experienced from their recent all-time highs, and this is what it gave me. So we've got Figma down 74%. Workday has been cut in half. Accenture essentially cut in half. Adobe down 42%. Microsoft, one of the 10 largest stocks in the S&P 500, it's a $3 trillion company, down 26%. It was a $4 trillion company, but $1 trillion in market capitalization gone, down 26% from its high. And the list goes on. So these are the types of concerns that we have, that perhaps it's not going to get built out to the extent that the market expects. but it's already built out enough that it is starting to cause some problems. And so these are the things that we need to continue to be focused on and attuned to, because they present macroeconomic risks for our economy. So let's move on. We're in year 2 of the 4-year presidential cycle, which happens to be the choppiest historically of the 4 years. So I also want to recall we are still in the middle of the most bullish 6 months of the year. So from November through April, those are your most bullish 6 months of the year historically. We learned that from our friends at the Stock Traders Almanac. But we also see that this year, we see that analog in the blue line here, it typically tends to peak in late April, May, which is when you would want to sell in May and go away. And then things are pretty rough through the summer, a little more volatile through the summer. But once you get into Q4, past the midterm elections, that is the most bullish part of the entire cycle. Now, are we going to follow this historical analog perfectly for this year? Who knows? We are not just going to blindly follow these seasonal trends, even though it looks like right now we're kind of tracking with it pretty well. But we want to align with actual trends in the market, but let's file away what these historical tendencies are, so we're not going to be surprised when and if they unfold. So with that, we're going to dive in and actually look at some charts of these key asset classes. We're going to start with the large cap U.S. stocks, the S&P 500 as a proxy here. So it's in an uptrend, but in February, the S&P was actually down by about 1%. And as we mentioned earlier, this is a big difference, a big change from what we've seen over the last few years, where the equally weighted S&P 500 index, it was up almost 3% for the month, but the headline S&P index, which is market cap weighted, was down. And so we are not in Kansas anymore. Those largest stocks that were buoying the market along for a long time, the shoe's on the other foot now. Mid-cap U.S. stocks, they also remain in an uptrend, had a very strong February, up almost 4%. But importantly, this is an area of the market that had peaked right after the election in 2024 and just gone sideways. But we were able to eclipse those former highs here earlier this year, which is a welcome sign for the bulls, and this has continued to move higher in the month of February. Small caps, Russell 2000, similar story, closed February at a new all-time monthly closing high. This is after 4.5 years of not going anywhere. Previously peaked in October of 2021, got back to those levels right after the election in 2024, continued to grind sideways, but we broke out over and above that level. We've been saying over the last couple months that our ability to sustain this breakout would be a major development. It appears that not only is that happening, but perhaps this train is leaving the station. International stocks, this has been an absolutely incredible ride. I'm old enough to remember when the consensus view a year ago was that tariffs and trade wars were going to be the death knell for foreign stocks. How's that working out for them? This is one of the strongest advances that we have seen in the developed international stock category in decades. But as of the spring of last year, we were still under the 2007 highs, where this index had made no appreciable advance for 18 years. But once we eclipsed those former highs, and we said we've got fresh pastures ahead, uncharted territory ahead, that was a historic breakout, and this remains one of the strongest asset classes in the market, up another 5% in the month of February. Emerging markets is a similar story, but perhaps they're still just in the wake of their developed international counterparts, because until earlier this year, they were still stuck below those former highs from 2007. But they broke out in January, and guess what? They tacked on another 5 to 6% in February. So is this one going to follow the same path of the developed international stocks and just pull away, or are we going to get some pullback in this index back and challenge these former highs? If we do, that's going to be quite telling. We would expect this former resistance to turn into support. So we're going to have to see how that plays out. Let's look at the bond market. U.S. aggregate bond index. It remains in a nice uptrend. It had just kind of been grinding sideways for a number of months, but it was finally able to pop above the former highs of that local range right there. We were up about 1.25% for the month of February. Commodities also gained in February, up about 2%. Gold and silver continuing their advances, but energy prices that had been troughing starting to move higher. If these tensions with Iran continue to worsen, I would expect that we're going to see oil prices rise even further, which is probably very bullish for commodities as a whole, but may have other implications for the market. Real estate, it is looking much better. The Dow Jones Equity REIT Index, it had just kind of been moving sideways like the bond market, but this one for about a year. But it was finally able to break out above that upper level of that range that had just been trapped underneath for a while. And so we've now got REITs that are back in an uptrend after being trendless for quite a while. So that's going to be it for the big picture overview. So if you are watching this review on YouTube, this is where this review will conclude for you. For our clients, it continues, and we highlight the holdings that we currently own within the strategies that we're managing. So if you are interested in learning more about the positions that we have within those strategies, send us an email to info@reveillewealth.com and we will follow up with you. But for now, I'm going to pass it to Chad for a recap, and then I'll leave us with some final thoughts.
Thanks, Stephen, for taking us through this month's review. To recap, equity markets exhibited continued signs of significant rotation during the month of February, with leadership continuing to shift from large U.S. technology stocks to other areas and sectors. In fact, large cap U.S. technology stocks were down approximately 2.5% during the month, while the average stock in the S&P 500 gained nearly 3.5%. Year to date in 2026, the leaders of the global equity markets are dividend-paying stocks, high-quality and value-oriented stocks, small and mid-caps, and international stocks, evidence of this rotation. Concerns around the sustainability of the AI bubble continued to grow during February, as signs of stress in private lending spread further. Long-term interest rates fell slightly for the month, helping to push mortgage rates down. And the U.S. unemployment rate stands at about 4.3%, and fears are spreading that this number could increase due to AI integration. In many ways, the future for the economy and markets is highly uncertain and warrants being able to adapt to a changing environment. And with that, I'll turn it over to Stephen for some final thoughts.
All right, thanks so much, everybody, for joining us for this review. We hope that you're finding it insightful. If there are ways that we can make it better for you, send us an email, info@reveillewealth.com. Give us your feedback. If we can get our compliance to approve those types of changes, we'd be happy to incorporate them here. But our objective, as always, is to try to be transparent with you and give you the most updated thoughts that we have on the market and show you how the investments that you have are aligned with the primary trends in the market. We don't want to be shaken by the news and the events of the day. We want to continue to align ourselves with the trends that we're seeing in the market. That will make sure that we are coming out and protecting your capital in poor market environments, but it also is going to help us to allow you to remain invested in markets that we need to be invested in, but we may not want to be. It may not be a comfortable ride all the time, but if we're following trends, we can have confidence along the way. Thank you again, everybody, for tuning in. We will see you next month. Take care. See you next time.